Good afternoon, everybody, and welcome back to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, joined as always by my good friend and colleague. How are you doing, Todd Anderson?
I'm well. How are you, Peter?
I'm doing great. And back with us again, we have the editor of Fintech Nexus News with us today, John White. How are you doing, John?
Excellent. Thank you. Looking forward to today's show.
Yes, indeed. A lot of news to cover, a lively discussion we have in store for you today. So let's get right into it. Just like last week, we're going to start the news with Stripe. I have a sense we might even start it with Stripe next week because they have been in the news a lot. The news last week was that Stripe may be going public at some point this year, and that is actually looking less likely now because the news came in, I think it was from the New York Times and the Information reporting that Stripe is going to likely raise money in a private transaction at potentially a $55 to $60 billion valuation, $3 billion in an equity fundraise. That is amazing. But it's going to be led potentially by Thrive Capital, which is Josh Kushner's company, Jared Kushner's brother, who runs a thriving venture capital firm these days. Yes, so it's there'll be another. There could be another story I said next week, but Stripe are looks like they're it's a down valuation, but still pretty damn solid. Wouldn't you agree?
Yeah, I mean, it's down from their bloated 90 billion valuation, but still 55 compared to probably where a lot of the early employees got their equity. It's I'm sure they can cash out nicely, which is what is a big driver behind this because some of their stuff expires, I think, at the end of the year. It does make me wonder, like, what was the whole IPO story about then? Like, it was this flashy news IPO that could go public, when in reality it was not really the exact opposite, but it should have been more like, Stripe planning transaction this year to, cash out employees, whether it be public or private. It was like, I know that they probably had some liberty with the headline because Stripe going public sounded infinitely better than hey, this is a private transaction to cash out employees. But I don't know. It felt like the initial reporting on the IPO was a little, a little overdone.
Mm-hmm.
I kind of felt like they were shooting up a flare to see what the reaction would be.
Yeah,
and it was quite an interesting, diverse reaction between years late, dollars short, and or this is amazing for fintech.
Well, if you remember the news last week was they may be going public or may do a private transaction. So everyone went, "Oh my God, public Stripe, that's fantastic. Let's put a headline out about that. That's gonna get lots of excitement," and it did. And in reality, we probably should have read it as may go public, may do a private transaction. Even at the time, many people, I think I even said it last week, that it could likely be a private transaction. So it's not,
And I think this has less impact on fintech overall.
Yeah.
I mean, I think it's a nice signal that they're able to hold a valuation that is still pretty hefty, even if cut down from their previous one. But a Stripe IPO event, a Stripe IPO successful event, would have been like a banner event for fintech overall. I think this is it's a nice thing. All right, Stripe was able to hold a pretty good valuation. That's somewhat good news, and it kind of moves on from there.
Yep. I mean, when you have a 30% haircut on your top valuation, that is in this market very strong. Very strong.
Exactly.
Okay. Let's move on. This came out late Friday. Custodia Bank rejected by the Federal Reserve, and this has been an ongoing saga. I think it's coming up close to 2 years now. Since Custodia Bank used to be called Avanti, right, Todd? I think that was their name beforehand. They put an application to the Fed to become a regulated bank, and have access to the Fed master account and that sort of thing. She even did a lawsuit against the Federal Reserve because they were ignoring her, and they're supposed to look at these things very expeditiously, and they had been dragging their feet. And she sued, or the company sued. Federal Reserve, Caitlin Long's CEO, has been quite outspoken about this, and it's a blow for her because they've really put a lot of effort into this. She says it's not the end. I mean, we had our own Isabel Castro did a great piece on this, where getting reaction from some of the people in the industry, covering tweets by Caitlin Long. Basically saying this is not the end, we're going to keep fighting. And she made the point, which I tend to agree with. She said, look, the regulators have said they don't want you to kind of beg for forgiveness. We want you to come in the front door and not the side door or the back door. That's what Custodia Bank is doing. They've got all this compliance and risk management in place, and still they can't even come in the front door. So it's it doesn't send a great signal, I don't think, government to industry at all.
It's funny. I have kind of two thoughts on this. One is, I wonder if they had gone in the side or the back door and amassed enough customers, if they would have been forced to kind of somewhat approve her. And it would have been like, she's, there's traction here, and that this is a bigger hit if we were to do this now. But she did everything right, and she didn't do that. Which not necessarily many fintechs, but a lot of fintechs, deal with arbitrage, and then, the kind of regulation ends up coming in after the fact. The other thought I had was, I don't think it's coincidence that after the FTX blow up, that she was eventually rejected.
Yep.
I think there was a lot of momentum in Capitol Hill. There was a lot of momentum last summer. And then all of a sudden you had Terra Luna, and then it was, Celsius, and you had this cascading effect, and then boom, FTX happens. And I think personally, this is just conjecture and totally guessing, that was the nail in their coffin, unfortunately, because I think they said, we need to pump the brakes on anything right now and be infinitely slower than we ever wanted to be. And we don't need an FTX coming from something that we approved.
They were caught up in the terrible tornado of all of that mess, and it was through no fault of their own. And my questions are, is that making the chill even worse? And will others pull their applications? The clarity, I think, will come over time, but not anytime soon, now that the regulators just putting a blanket over it.
Well, yeah, I can't imagine anyone else who's got I don't know if there are other crypto applications for banks. I think there might be one or two, actually.
I think there's a couple out there, but I mean, ultimately, I personally think they were treated unfairly here.
Yeah, I do too.
If you're going to reject them within the window. If you're not, then try to work with them to get it approved, and not silent, which I think was her biggest frustration, which was there was just dead silence for so long, which is why, I think the suit came on from, because she was pushing for answers. And then ultimately, I think they were unfairly treated after FTX.
Yeah. I mean, FTX was a nail in the coffin. I think that's pretty clear. But even so, I mean, they dragged their feet. The Federal Reserve is sure, oh my goodness, this is new, this is innovative. We can't possibly understand this, and we want to drag it. We want to drag it out as long as possible. And FTX gave them a great excuse, I think. But I think it's it's not a good look for the government, in my opinion.
Do you think, quick question for you, Peter, do you think if we eventually launch a CBDC here in the States, which sounds like we'll eventually get there, wouldn't it make, applications like this, wouldn't it kind of push them to have to happen?
I would think so, yes. But
so it's like the government might end up doing that, yet they're rejecting stuff right now.
Well, I think they're
working on it.
And I think my personal feeling is Custodia Bank is going to get approved, and it's going to get approved, maybe not this year, but probably next year. And there will be this sort of, it'll just be a historical thing that, they were slow, but I feel like a company like Custodia have put all their ducks in a row. They are the exact opposite of FTX in so many ways. They are very bank-like, but I think
the whole team over there is bankers, as far as I know.
So, they're very experienced, and I think it's going to happen. Anyway, we need to move on. Talking more about the government here, the CFPB has said they want to eliminate screen scraping. The scourge of banks, or in many fintechs have been screen scraping for a long time, and this Plaid still does it today because it's if you don't have an API connection, it's really the only way to get credentials through.
Yep.
But this is all about giving. This is all like Section 1033 as far as the CFPB is concerned. Section 1033 of Dodd-Frank, which is all about giving users control over their financial data. We don't know how it's going to play out, but we know that the CFPB really have this as a major push this year. And what there's, the ICBA, the Independent Community Bankers Association, is dead against a deadline. They've put forward a deadline, which I think is a little bit unrealistic or unacceptable. 5 to 8 years they want to eliminate.
Quite the window.
They want time to really get with the program and actually remove screen scraping and go with an API focused system. But even Plaid has said Plaid connects to every bank in the country pretty much, and if you don't have an API connection, they want to connect with you via API, then they still do screen scraping, and they also want to have access to all the banks, and so they don't really want an abrupt end to screen scraping. But reality is, as technology gets cheaper and cheaper and cheaper, a lot of fintechs will help banks connect through API. It's hard if you're a tiny community bank, but boy, unless you've got $20 million in assets, you should be able to get this done, I would think.
Yeah, I'd have to imagine the number of banks that fall into the category of unable to accomplish this in a fairly, say, even give them 18 months to 2 year window is probably pretty small. If you want to, 5 to 8 years, I agree, is ridiculous. We're going to be on to the next thing in 5 to 8 years. And if they can't handle, an API transition to accommodate for that, then in 5 to 8 years, they're going to be way behind the curve. I think it's, in a lot of ways, it's protecting the small banks, which is exactly what the ICBA does. I think something that Plaid recommends is kind of a phased out. Maybe the smallest of small banks have like extra time to get there, and 90% of banks fall under the 1033 in the next year or two. I think there's ways that you can accommodate for the smallest of the small and not necessarily worry about the 90% who can accommodate this.
That was going to be my suggestion: a scale-based deadline. I was thinking, standardized bank software is like herding cats, so I can only imagine getting everyone on the same page is going to be a challenge even for the bigger banks.
You'd think, wouldn't the cores step up right here and be like, hey, we can help you get there?
Yeah, that's where it should be. But the thing is, what I think the article even mentioned this, it was in Banking Dive, that they're charging money. They're charging extra money for this API connectivity, which is fair enough. It's extra functionality. It's additional. Banks don't want to pay. But you know what? That's right now,
that's going to be infinitely cheaper than trying to figure this out yourself with almost no technology staff.
Well, and not only that, it's getting to the stage, if you're a community bank and you don't connect through Plaid, then you are risking losing customers, because it's a bad user. You're providing your customers with a bad user experience, and I think that's something that they just can't have for much longer, I don't think. Anyway,
I would agree.
Moving on, American Express. It's a sad day, sad week, really, in some ways, because the Kabbage brand is no more. Kabbage is now being phased out, and you talk to the Kabbage people, and I've been in contact with one of their guys this week, and it's a great day because now we're all part of American Express. So Kabbage is now American Express Business Blueprint. That's what they're calling themselves, which is basically providing one-stop shop for small business. You've got your loans, which is what Kabbage was built on, lines of credit and short-term loans. You've got your small business banking, which Kabbage released soon after the acquisition by American Express. And then you've got this Kabbage Insights, which is now just cash flow insights. And these are good products, I think. And now they've brought under the American Express umbrella. It's no doubt that when it comes to small business, American Express has a stronger brand than Kabbage, and I think that's what they've kind of realized here. but still, it's hard to know how compelling this offering is going to be.
I'd be curious if the Cabbage or the American Express brand carries the same weight as Cabbage amongst the people that were familiar and used to using Cabbage. Like, will there be some churn with someone that says, I went to Cabbage because they were fast, I had money next day or within 2 days, and it was all tech based and it was good. It might cost a little more, but it got me the money very quickly when I needed it. Like, is the new American Express offering the exact same? And B, will they trust the Amex or the fintech that they were used to knowing that was nimble and fast, or will they think that there's slowness that it'll take a week now instead of 2 days?
Yeah, good questions.
And so when did this buyout happen? Was it 2.5 years ago?
Yeah, it was like 2.5 years ago. Between 2.5 and 3 years ago. Yeah, it was in 2020.
Wow.
In 2020 when this acquisition happened.
Man, time flies.
My thought was, if it takes that long, they must have completely rewritten the code. So you're right. I would think it's going to be interesting to see if they've maintained the user experience everyone comes to expect.
Yeah, I can't imagine that it's worse. That would be ridiculous.
It'd be the first time.
But if you're used to money in 2 days or a day, is the American Express underwriting and decisioning as quick?
No, I think it will.
And
I don't think there's any question. I don't think there's any question that it will be as quick.
Then it shouldn't be a big difference at all.
Yeah, I think you raise a good point, Todd. Is the Cabbage customer, are they as comfortable with the American Express brand as they are with the Cabbage brand? That is unknown. American Express with non-Cabbage customers, much stronger brand. But that will remain to be seen. But it's a competitive market. Square have a whole bunch of products that are there to compete. I mean, Intuit as well. It's the American Express aren't going into this alone. That's for sure. Anyway, let's move on. And now I want to talk about this article by Dave Birch. Really enjoy his writing. He's columnist in Forbes. He's also someone that I've met several times and great speaker at events. He wrote this very interesting piece around digital wallets. So we've been talking about digital wallets here for a while, with obviously with the movement by the Zelle kind of consortium of banks trying to create their own. But he was arguing, let's forget about payments. Let's just talk about digital identities and he's written. I remember a column he wrote, might have been 2 years ago now, that he was talking about banks really should be leaning into becoming the sort of custodian of digital identity, and they haven't really done much in that way. But what he's saying here is that people are going to use their digital wallets to store their card and their payment mechanisms, as well as their ID. And already you've got like your COVID card is in a digital wallet or in a digital form. And in Colorado has digital driver's licenses now, which I think can use at the airport starting sometime this year. And it's we're moving that way. So he's saying, well, let's not worry about payments. Let's think about digital identity, and that is going to be the key to success in the wallet wars, as he calls it. Super interesting, I think.
Yeah, I would agree. Go ahead, John.
I was just going to say, and I also love his cartoonist. That's a personal favorite of mine. If you haven't seen it, you really have to.
Yeah.
But some of this is reliant on government again, though, because we need New York and California and Texas to all say you can put and ultimately the federal government, can you put your passport into your phone? Because to me, that's when it almost immediately overnight switches that your phone becomes your wallet once your IDs go in there. Because the only thing holding back massive adoption of digital wallets, at least in my view, is the government saying your ID is on there. Because you still need physical ID in 90% of the places in the U.S. I think it's 3 states right now have it. The wallet: Arizona, Nevada, and Colorado, if memory serves correct. So when that happens, the digital wallet takes off. But when is that going to happen?
It's
I
inevitable.
hope soon.
It's inevitable.
Yeah, I think it's inevitable. They're just probably trying to figure out how do we deal with a license versus a passport, and how do we deal with fake versions of those
Yeah,
on the
that's the big
phone.
issue.
And so I agree it's inevitable. But I mean, he makes a good point about digital identity.
Yeah, indeed. Okay, let's move on. We're going to talk about Celsius. It seems like every article I read about Celsius, the picture gets bleaker and worse. It's like I feel like they've they're in bankruptcy now, and there's this report that was in Decrypto that we read about this earlier this week. We put it in our newsletter. 689-page report on Celsius. Now, that's some great reading right there. If you've got, you're stuck in a desert island for a month or whatever. It's, but anyway, saying what they basically said is there were serious problems at Celsius dating back to 2020 or even earlier, and where they were doing a similar thing to what FTX is doing and using, customer funds to go and fund different activities and make different loans. And it's a bad look. It's a really bad look. And it, clearly makes their exit from bankruptcy less and less likely. It's just looking like they're not ever going to be a going concern ever again. And if you read some of the details of the report, which was summarized to some extent in this article, there's some really bad stuff that went down.
So, two things come to mind. First is, how common is this in crypto platforms? I mean, FTX, Celsius. I mean, it's, the names are stacking up, unfortunately, because me and you personally know many people and many companies in the space who are way above board and doing things right. But the more Celsius and FTXs of the world, the more the rest are going to be impacted by overregulation. The second thing is who was asleep at the switch here? I mean, investors kept putting money in.
Right.
I mean, if it dates back to pre-COVID, I mean, that's years.
Yeah.
That's not like, there was a 6-month span where they came to a certain fork in the road and they went the wrong way. Like, that was built into their business clearly, if it's pre-COVID or even around COVID. So there was a lot of people asleep at the switch or just didn't care.
Mm-hmm.
Or intentionally doing the improper behavior.
Well, I think some of this might stem from the fact there was a big fear of missing out amongst VCs, and also with that driven by these shorter time frames and less due diligence. I think this was a perfect time for a dubious company to kind of not coming to there's not a deep dive into as much as there would have been in 2017, 2018, and I think this is the result. We
speed to market killed
it with FTX, we saw it with Celsius, we saw it with BlockFi, we saw it with many companies where clearly things were not as rosy as the founders were making out.
And when people make money, they overlook, that number doesn't seem to make sense.
Yeah.
Well, no, I'm trusting the team,
right?
And
we're investing in the team.
Back.
Yes.
Yeah.
Okay. I'm going to talk about earnings real quick. SoFi had a pretty solid earnings report this week. Their revenue was a record $443 million for the quarter, up 72.5% year over year. Loan origins, though, declined. A lot of that was due to the student loans, the personal loans did pretty well, just under 10 billion for the year. So and personal loans across the board have declined in the fourth quarter. It just seems that everyone's doing less volume than they were. SoFi, I mean, stock is up, diversified company, lots, they've got their Technesis and Galileo division, their technology division that I know they laid off some workers in that division, but that's something that's totally diversified from the consumer business. It seems like they're starting to hit their stride.
SoFi and Lending Club each did similar strategies of essentially buying their bank charters.
Yep.
And if I was a fintech right now, and I know that we're dealing with layoffs and cutting expenses, I'd look to buy a small community bank. And it would, I mean, just look at where was Lending Club 2 or 3 years ago, Peter. I mean, they were down in what, pennies, the stock price?
It wasn't quite that low, but
it was almost there.
pre-adjusted or stock split, or reverse stock split. They were down probably $2, maybe. I think it was under $2.
It was down like 95% from where they went public.
Yep.
Now look at Lending Club. I mean, they are solid and just keep doing better every quarter. And they'll have their ups and downs. As the economy gets good and bad, whatever. But the entire shape of that company changed when they acquired the bank. And SoFi was doing better than Lending Club prior to buying the bank. But look at them now. I mean, if I'm a fintech, this is the future for you. Yep.
Particularly fintech lenders, for sure.
Yeah.
And my only note on that story was bank charter saves the day.
Well, that's the truth. That's the truth. I mean, you look at what Scott Sanborn said. You look at what Anthony Noto said. They're really happy to be taking deposits right now and lending them out and earning the spread on that, because even right now you can these fintechs are paying more in deposits than the average bank, but they've also got a pretty nice spread when it comes to what their average interest rate is on their personal loans. They're not lending these out for mortgages for the most part. There is some mortgages at SoFi, but for the most part, these are double-digit percentage personal loans, and that's a good business. Anyway, we have our weekly look at layoffs. We're not going to dwell on this because I want to cover one more story before we close. PayPal, 2,000 jobs, 7% of the workforce. Upstart, 20% layoff, 365 people. BM Technologies, 25% of the staff there. FIS, the monster, they call themselves a fintech. They're really an enterprise technology firm in my book. But they're the ones that provide the banking core to so many of the banks in this country. They're cutting 2,000 plus jobs as well, which is only a tiny fraction of their workforce because they're a behemoth. But still, there's lots and lots of layoffs. But what I want to end with today is this really great series from Kevin Wack, who we know quite well. He's been an American banker for many years, spoken at our event or moderated sessions at our event many times. He has written a series on Wells Fargo, and this is a real behind-the-scenes look at the whole kind of fake account fiasco that was happening inside Wells Fargo a few years back, and got some firsthand, some reports on that. Just a fascinating story.
Yeah, I think, Peter, you said it this morning. It's had that Spotlight type feel, or if the people didn't watch the movie Spotlight, the new movie that came out recently, the She Said movie, which is, I mean, it's just hardcore journalism at its best, of sticking with a story, finding a source, talking to the source, and talking to the source, and
working the source until you get what you need.
Yeah,
it's very inspiring as a journalist.
And I think a lot of people, should read this. Because the Wells Fargo CEO just made, I think, $29 million.
Right. Well, this was not on his watch, to be clear.
No, but still, the bank is doing fine now.
Oh, yeah.
Even with this giant scandal. But then you look at some of the fintech issues that we've dealt with or talked about in recent months or recent years, and it's like, crush them. Yeah. I know it's different size and scale, but still, this is a massive scandal. And Wells Fargo has gotten past it now in many ways. Yep. Congress still throws them under the bus here and there, but that's Congress for you. So it's fascinating reporting. I haven't read it all yet, but I certainly have bookmarked it.
Yep.
I just finished part 1, and his writing is very compelling. It's like a crime thriller.
Well, I know he spent a long time, researching this, and he says, 30 interviews with the main guy that he's got, who was like the head of security at Wells Fargo. 30 interviews. That's some in-depth reporting right there.
Dedication.
Yes, it is. Okay, well, that is going to do it for us this week. Thank you all for watching or listening. We'll be back same time next week, 5 p.m. Eastern time. But before we go, a reminder, if you haven't booked your ticket yet for Fintech Nexus USA in New York City, what are you waiting for? go to fintechnexus.com. It's going to be a fantastic event, biggest event on the East Coast this year when it comes to fintech. Hope to see you there. Thanks, John. Thanks, Todd, as always. And we'll see you next week, everybody. Bye.
Yep.